Global stock markets continue to make impressive gains in July. For Canadian investors, the rewards were even more pronounced thanks to the US dollar's strength against our loonie. We'll never complain when markets are doing well, but the growing disconnect between investor euphoria and real-world challenges is reason for concern. While stock markets have overcome this wall of worry before, this acute sense of complacency often leads to more challenging periods. Retail investors are pouring money into equities, but institutional players appear to be scaling back their exposure. The Trump administration's reciprocal tariffs take effect this month, impacting global trade relationships. While lower than what was announced on Liberation Day, they still carry significant weight. The average tariff rate on U.S. imports looks set to rise from roughly 2.5% in 2024 to somewhere around 20%. That's the highest level seen since the 1930s. Negotiations are still underway with key trading partners such as China, Mexico, and Canada. For the time being, American businesses and consumers will foot the bill for an estimated $300 billion in tariff revenues. Higher prices tend to harm demand, which will also stunt economic growth in many countries. We're already starting to see signs that pressure is building. Inflation is heating up as job creation cools off. For now, investors have chosen to turn a blind eye to this more challenging landscape. Instead, they're focusing on recent earnings results that have generally beat expectations. This has only strengthened the ongoing secular growth theme of artificial intelligence. However, judging by the multi-billion-dollar hit to the global auto industry, it may not be long before other industries see their earnings slouch. Of tariffs, deportation, shrinking the labor supply, and bringing back domestic manufacturing will all weigh on profit margins. Investors are also hopeful that North American central banks will cut interest rates before the end of the year. But the fact that both recently chose to maintain monetary policy at current levels shows the dilemma they're in. Cutting rates too liberally could stoke inflation, while staying put might harm the economy. Closer to home, 90% of Canadian exports to the U.S. have been protected by our current trade agreement. Tariffs on steel, aluminum, lumber, and the auto industry, however, have been punishing. Current negotiation tactics might give us an idea of what the U.S. will expect from Canada when the trade deal comes up for review in 2026. In the meantime, our federal and provincial governments are racing to reduce American dependence. We've made promising inroads with new trading partners abroad and between provinces. Canada's first shipments of LNG to Asia were a positive first step, but unlocking our energy economy will take time and money. Enthusiastic investors continue to drive stock valuations higher, but we're taking a more cautious approach, given the recent slowdown in the labor market. Consumer spending drives the North American economy. Of course, this needs to be maintained through wage growth and job stability, which might not be a sure thing. Bellwether's investment strategy has multiple layers to deliver returns. It's also designed to mute volatility and protect against market downturns, which, as we saw in April, can happen at any time. Portfolio diversification, an emphasis on stocks that grow dividends, and exposure to alternative asset classes should all serve our clients well through a full market cycle. We have also been gradually deploying capital into attractive private equity opportunities with a current focus on Europe.